Assalamualaikum warahmatullahi taala wabarakatuh. Wassalatu wassalamu ala sayyidina Muhammadin asyrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Allahumma rabbi zidni 'ilma warzuqni fahma. Okay, hi, assalamualaikum again. So we'll continue our discussion on past semester questions. Today we are doing January 2024 and question past semester test. It's listed in the telegram, which is the June 2022 or January 2022. So if we have time, we'll discuss all the questions. If not, then we'll discuss one of the questions in the class. Okay, get ready to have the questions past semester January 2024. Okay, the questions, this is questions 2, Kingdom. The Kingdom of Emirates has awarded East Road Constructions, ERC, a contract to construct a 53-kilometer highway project to link the Emirates of Dubai to Ras Al Khaimah by a single stretch highway. The project cost is expected to be 35 million. So the important thing in this question is start from this information, which is project costs. Okay, the project cost 35 million. And below is the optimal capital structure of ERC as 30th June 2023. So we are given here debentures, preference shares, own shares. So as usual, start with the computing the weight of financing, own shares, and retained earnings. We group as the common equity. Okay, common equity. Right, so 17.2 million divided by 100 million. That will be your weight of financing for the debentures. So 0.172. Okay, 0.172. So here divide by 100 is 0.148. Here is 0.47.5. For this retained earnings and ordinary shares will group together, which is 47.5. Add with a 20.5. Add with a 20.5, so it is 68. So this two is the 0.68. So the total must be 1. Okay, 0.68 plus 0.148 plus 0.172. So the total must be 1. So the finance manager proposed the following. Propose the following source of financing to funding the project. First one is the issue 5% 10-year debentures at a market price of 1,050. Okay, 5% debentures, that is 5% interest. So this is interest multiplied by the par value. Remember, it's always interest calculated at the par value 1,000. So this is a 50. The interest. Okay, then market price is 1,050. So this is a market price. Flotation cost 10% of the market price. So that means 1,050 multiplied by 90%. 90%. So it is 945. Okay, on the expiration of the maturity, debentures will redeem at par value 1,000. So we settle down the cost of debt first, which is to find what is the KD after tax. Number one. B number 1. So we are doing B number 1 dulu. So this is B number 1, KD. Okay, KD after tax. Okay, so you need to try and error or choose and pick what is the suitable or appropriate the discounting rate. Okay, so I want to try from the rate of interest, which is we try 5%. Okay, so the interest 5% is 50. Okay, 50 multiplied by annuity 5%, 10 years. So it's a 10 years. 10 years. Then principal redeem at par value, which is 1,000, multiplied by non-annuity 5%, 10 years. Okay, so you need to refer to the table, annuity table and non-annuity table. Okay, for the 5%, 10 years, it is 7 point, you need to recheck, counter check or double check in the present value table for the annuity. Is it the correct 5% 10 years 7.7217, and 5% 10 years non-annuity is 0.6139. So you multiply that to get the present value. So this is the discounting factor and this is the cash flow. So you multiply that, that will give you 386.08 and 613.9. Okay, so this will be the subtotal. So this one is, we call it as the present value of cash flow. Okay, so the 386.08 plus 613.9, so it's 99 almost to the par value, because you are using the coupon rate. This we call it as the coupon rate or interest rate. So when the coupon rate sama dengan discounting rate, usually the value par value discounting rate, so par value and present value is similar. So this is par value, this is present value, both are PV. Okay, par value equals to the present value, almost 98. So the difference is due to the decimal. Okay, less the issue cost. Okay, issue cost or issue price. Issue cost or issue price discount is 945. 945. So the present value of cash flow is the revenue. So this is your cost. This is a cost. So the cost minus the cost is less than the revenue. So you'll get a positive NPV, which is 54.98. 54.98. Okay, then we try another one. So we get positive. So we need to increase. We need to increase the rate. So before we try 5%, maybe now we can try 7%. We increase a bit. So the interest is still 50, and par value redeemed at principal value at par is still 1,000. So now multiply by annuity 7% of 10 years and non-annuity 7% of 10 years. So refer to the present value table. So you got here 7% 10 years annuity is 7.0236, and here's 0.5083. So you multiply, you get the PV is 351. Okay, the smaller discounting factor will give you the lesser present value. 351.18, and here is 508.3. 508.3. So, and the subtotal, the present value of the cash flow is 859.48. Okay, and the issue cost still at 945. So here the issue cost is more than the revenue. You will get the negative NPV. Okay, so 945 is higher, the issue cost. So this is the issue cost is more than the PV of cash flow. So you will get the negative net present value of 85.52. And after this, we'll do the interpolation. Okay, so do the interpolation because we have the range of the range of multiply, okay, plus the difference 7 and 5, okay, 7 and 5. So here we start with the positive, which is 5, okay, so 54.98, start with the positive NPVRM, then total of positive and negative, plus 85.52. So this one, you get the 5.78, and after tax multiplied by 0.76. Corporate tax is given as 24%. So here, corporate tax rate at 24%. So after tax is 1 minus TC. So it's a 0.76. So that will give you 4.39% interpolation. So that is our KD. That is our KD. Okay, then we can straight away doing part C. Okay, we can straight away doing part C. Okay, part C is for you to calculate the estimated overall cost of capital. Cost of capital, which is the WACC. So this one you boleh terus buat capital structure, what is the individual, what is the weight of financing, the cost of capital, and what is the WACC. Okay, capital structure consists of debentures. Debentures is a debt. Then you have the preference shares, you have the common equity. Okay, the weight of financing we already computed here, 0.172, okay, 0.148 and 0.68. Okay, the real cost of capital just now we already computed for the redeemable debentures, 4.39. Okay, 4.39 multiplied by that weight of financing, it gives you weighted average cost of capital as 0.755. 0.755. You can take 2 or 3 decimal. 755. Okay, so now we want to compute for the number 2, which is preferences. KP. KP for the preference share. So it's a dividend divided by net price, or the market price less the flotation cost. So 7% preference shares at the selling price 110. So this is a market price. Issuance cost 110. Issuance cost is 2%. So multiply by 98% here. So that is 98%. So 107.8. Okay, so 110 multiplied by 98 is a 107.8. So here dividend 7%. Dividend is 7% on par value. Par value is 100. So this one nominal value, par value. Okay, 100. So that is 7. Right, so 7 divided by, so KP here 7 divided by 107.8 divided by 100, that gives you 6.49%. Okay, so then you put it here, 6.49% multiplied by 0.148, that will give you 0.961. Okay, next we'll continue to the calculation of ordinary shares. So here issue ordinary shares at market price of 10, flotation cost associated 4%. For the KE, no need to calculate the flotation cost. So ERC expected to pay dividend 1.18 next year. So this is already D1 compared to 1.1 this year. So this is the DO. So ERC is positive that dividend will grow at a constant rate of 8%. So we just take the D1, straight away D1. So if you want to calculate as 1.1 as a DO, also is possible, no problem, because 1.1 if you multiply by the growth rate 1.08, 1.1. Okay, 1.1 multiplied by 1.08. So you are getting 1.188. So you can take as a D1 or D1 plus G. So for the third one, KE for the retained earnings. So I just taking the D1 direct. D1 direct 1.188 divided by KE, no need to have the flotation cost, so you just take the market price, 10 ringgit. 10 ringgit plus the 0.08, the growth rate, the growth rate. So you will get 19.88%. And KNE for the ordinary shares, 1.188 divided by, so this one you need to less or net off the flotation cost. So here flotation cost is 4% of the market price. Flotation cost associated with the issuance is 4% of the market price. So 4% means multiplied by 96 plus 0.08. So that is 20.38%. Okay, so now to put in your WACC for the common equity, whether you want to choose or select KE or KNE, you need to calculate the maximum capex. Okay, so the maximum capex is the retained earning available for reinvestment divided by the weight of financing. Weight of financing equity is 68.68. So here 0.68. So ERC restrict its retained earnings available for investment to the maximum of 80% on the retained earnings balance as at 30th June 2023. So the balance as 30th June is 20.5 million, and the ERC is using only 80% from the 20.5 million. Okay, so this will give the maximum capex as 16.4 million. Okay, don't forget to divide by 68. So the maximum capex is about RM 24.1 million. 24.1 million. So 24.1 million versus compare with the cost of project. So how much is the cost of project? So it's stated here in the questions, the cost of project is 35 million. 35 million. So that means the cost of project exceed the maximum capex. So the retained earning insufficient. Okay, because the cost of project exceed. You need to make a simple conclusion or decisions making. Exceed the maximum capex, then company, the ERC, okay, ERC needs to issue new share. Means use K and E. Okay, use K and E. All right, so use K and E, that means we are taking 20.38. 20.38 here. 20.38 multiplied by 68. So you got here 13.858. 13.858. Okay, then you add together. Okay. So interpolation ni kita we need to move the word interpolation because it is skip. Okay, interpolation. Okay, so this one So you add together 7.755 plus 0.961 plus 13.85. So it is 15.57. 15.57%. So this is your WACC. So your WACC. Okay, so question A. Question C is done already. Question A. Question A is you need to determine the number of debentures or the number of debentures or the number of bonds. Okay, number of debentures. Number of bonds or debentures issued. So first, you need to know what is the debentures financing requirement. Debentures financing requirement based on the weight of financing. So the weight of financing just now is 0.172. 0.172 multiplied with the cost of project, which is 35 million. So you are getting the debt financing requirement is about RM 6.02 million. So let me check 172 multiplied by 35. Here is 6.02 million. And the number of bonds or number of debentures, you divide by the debentures price, RM, okay, 6.02 million divided by the RM debentures price. Debentures price is 945. Okay, 945. So this one is 6.202 million. So don't make mistakes on that. Okay, so number of debentures issued, that one is in unit. Okay, in units. So 6.02 divided by 145. So it's about 6371 units. 6.602 945. So 6370 units. So this is the answer. Okay, for question A. Right, so finish question part A, Kingdom of Emirates, A, B, C, and B, debentures after tax, preference shares, internal equity, ordinary shares. Okay, next we go to the question specific cost project, which is question B. Okay, Baxter Energy. Baxter Energy is a refinery oil manufacturer wishing to embark into hospitality industry in conjunction with the Visit Malaysia campaign. Currently, equity to debt 4:1. So equity to debt, so equity, debt, value, total value. So equity is 4, debt is 1, so total value is 5. Okay, beta value of Baxter equity is 1.15. So beta value Baxter, this is the beta equity Baxter. All right. Beta equity Baxter for refinery oil manufacturer. So this is the existing business. We will not use this because we want to use for the new business, which is the hospitality industry. So we need to calculate the new one. So this 1.15 beta equity is not relevant to our calculation because it is for the existing business, refinery, oil manufacturer. We need to calculate the new one. Okay, rate of return of a risk-free asset. So this is the RF. And the average return on the stock market, this is a RM. and this is a TC, the tax rate. A company known as agrotourism has been identified as the proxy to undertake a project in agrotourism hospitality. The company has an equity beta of 1.8. So this is beta equity tourism. So equity to debt ratio. So equity is 3, debt is BE is 3, BD is 2. So existing capital remain unchanged. Calculate the project specific cost and advice. Okay, first we need to calculate. So step by step. Okay, step 1, you need to ungeared dulu. Ungeared beta equity proxy to get beta assets proxy. Okay, so this one is proxy company. Proxy company, so which is proxy company is the agrotourism. Agrotourism. So we need to ungeared. So to ungeared is you need to find a beta assets. Beta asset is beta equity multiplied by value of equity proxy, divide by VE plus VD 1 minus TC, because there is a tax. There is a tax rate 24. Okay, so it is beta asset. It is BA. BE is okay. BE proxy. So this one, equity beta. BE 1.8. 1.8 BE is 3. Okay, divide by 3 plus 2. 1 minus TC 0.76. Okay, so 1.8 multiplied by 3, so it's 5.4. So this one is a 5.4. So you need to settle down BD dulu. 2 multiplied by 0.76 plus 3. So you got 4.5. This one 4.52. So 5.4 divided by 4.52, that will give you 1.19. You can take 2 or 3 decimal. So it is 1.19. Okay, 1.19. Then step 2, regeared. Okay, step 2, regeared. Beta asset proxy to get beta equity our company, Baxter. Okay, so Baxter is our company. So we get the new beta equity which reflect the business risk in the hospitality using our proxy agrotourism Berhad. So now we want to calculate the BE. So BE is the beta asset multiplied by BE plus BD 1 minus TC, okay, divide by VE. Okay, so here BE is BA is 1.19. Our company VE is 4 plus BD is 1 minus TC 0.76. Okay, then divide by 4. Jadi settlekan yang ini dulu. 0.76 plus 4 multiplied by 1.19. So it is 5.66. So yang atas ni 5.6644. Then you divide by 4. So you got 1.4. So you got 1.42. So you round up 1.42. Okay, so 1.42. Then you can put in your specific cost of project. Step 3. This is your CAPM, using CAPM model to calculate your PE, which is your specific specific cost of project. Specific cost of project. Okay, so RF. So RF here is RF plus beta RM minus RF, which is RF here is risk-free 6 plus beta 1.42. So the RM is 15% minus 6. That will give you 18.78%. Okay. So if you have the information on VD, VE, and the weight of financing for each equity and debt, then you can continue to step 4, which is to calculate the new WACC. But unfortunately, we don't have that information on the weight of financing and information on the KD. KD. We have the weight of financing in terms of capital structures, which is value of equity is 4, value of debt is 1. Okay, from there we can find the WOF, but we don't have the cost of debt, so we cannot find what is the WACC. Okay, with these questions finished for past semester questions. I hope you understand how to answer questions cost of capital for the existing business, right up from the computation individual cost of capital until maximum capex, and determine what is the weighted average cost of capital. And plus the other one is the specific cost of project, which is to calculate the new cost of capital for the new business based on the steps of ungeared beta equity proxy to get the beta asset proxy, then the step to re-gear the beta asset proxy to get the beta equity our company, and calculate the specific cost of project based on a CAPM model, and finally determine what is the new weighted average cost of capital. Okay, so now we want to move to the doing questions test. So I plan to do continue with the questions test January. Sorry, it's not January, but it is June 2022. June 2022 here. Okay, so we'll continue with the test kat sini, June 2022. Okay, question 1. Which of the following figures is irrelevant while calculating the cost of redeemable preference shares? Okay, preference shares, flotation cost. Yes, this is important when we want to calculate it, and when we want to calculate the net price. Net price. Okay. Okay, let me change the. Okay, now. Okay, discount. This one is on the issue whether the company wants to issue at discount or at premium. So this is also important. Okay, net proceeds. This is the market price less flotation cost. So this important. This information is relevant. Okay, so the not relevant is C, earnings per share. Okay, question 2. Zabum is expected to pay annual dividend of 60 cents per share next year. So next year is already D1. The stock's par value and market price 15.6 and 20.6, and the growth rate 5%. Calculate the firm's cost of equity. So the firm cost of equity. So this is the internal. So internal sebab dia tak kata. It can be external juga. But since there is no flotation cost, so we can regard or can assume that this is for the internal. Okay, so 60 cents, calculate KE. This is the 60 cents divided by market price. So this is the stock's par value. So this is a PV. This is the market price. This is the growth rate. So the growth rate is a 5%. Okay, so 60 cents divided by market price 20.6. Okay, plus the growth rate is 0.05. So the answer is 7.91%. So the answer is B. Okay, question 3. Zigzag has announced to issue 6% preferred stock at discount from its market value. Okay, so 5%. So you less with the discount first. Okay, less discount, less number 1 discount rate dulu, discount. And number 2, then you less with the issue cost. Issue cost or flotation cost. Flotation cost. Okay, so here the market value is market value of preferred stock is 120, 140 at par and market price respectively. So 140 lah. So 120, this is the par value. Okay, so discountkan dulu 140 multiplied by 95. Okay, so that is 140 multiplied by 95. So that is 133. Then after that, barulah you compute for the less of the issuance cost. So 133, and because the issuance cost is 2% of the issue price. So this is the issue price. This is the issue price. So 133 multiplied by 2% or 98%, 0.98%. Okay, so 133 multiplied by 0.98, so 130.34. Okay, so KP, preference shares, dividend is 6%, 6% of the par value, 120, divided by net price is 130.34. So 6% out of 120 is 7.2. So this one is 7.2. So 7.2 divided by 130.34. So it's about 5.52%. 5.52%. So the answer is A. Question 4, GBAM is planned to issue common stock at a market price 16. The underwriting cost to be paid is 5%. Based on its market value, the firm is expected to pay dividend 1.254 per share next year compared to 1.2. Dividend expected to grow at a constant rate per annum in the foreseeable future. Okay, so it seems that the dividend growth rate is not given, so you need to calculate. So calculate the cost of new common stock. So this is a K and E. Okay, we settle down the growth rate first by taking the last year, this year. Okay, this year 1.254, 1.254 minus last year 1.2 divided by last year 1.2. So the growth rate is 4.5%, 0.04%, 0.045, 0.45% or 4.5%. Then we can calculate KNE as dividend next year, which is 1.254, okay, plus growth rate 0.045, okay, divided by market price minus flotation cost. So 16 multiplied by 95%. Okay, so that will give you 12.75%. So the answer is D. Okay, question 5. Mulawi Tech, a software developer company, have a beta of 1.2 in its share, which indicate high risk compared to the market beta. Market risk premium is 6% and expected return. So this is a RM. Okay, this is the RM minus RF lah. The market risk premium. This is a risk premium. Is the difference of RM minus RF. Calculate the cost of equity capital for the firm. So since you are having beta, so that means you need to use the CAPM. CAPM, which is the RF plus beta, RM minus RF. So you need to find the RF. So RF, the risk premium is 6. So now equivalent to RM 10 minus RF. So RF is 10 minus 4 lah. Sorry, 10 minus 6. 10 minus 6, so it's 4. So here is 4 plus beta 1.2 multiplied by the difference of return on market and risk-free is 6. So 11.2%. Okay, 11.2%. So 1.2 multiplied by 6 plus 4. 11.2%. The answer is A. Question 6. Black Bolt Incorporation plans to finance part of its new projects by issuing new corporate redeemable at a premium 15% from its par value 1,000 at a premium. So that means it will be issued higher than, higher than the par value. Period of redemption is 10 years. Flotation cost associated with the issuance is 4% of the issued value. Using interpolation, the firm identified that positive NPV rate used was 7%, 36.42 NPV, 9% use results in negative NPV, 104.01. Assuming company tax rate is 24, calculate after tax cost of redeemable debentures. Okay, so this one means that you already given information on the positive, negative NPV and the range rate, which is 7% and 9%. So just continue to do interpolation. Okay, so the interpolation will start with the positive NPV, which is 7%. Okay, 7% plus positive value 36.42 by 36.42 plus negative value 104.01. Okay, multiply by the difference. Okay, multiply by the difference. The difference is 9 minus 7. So that gives you 7 point, it's about 7.52%. So the answer is D. Okay, question 7. Sultana Berhad, a food manufacturer company, is planning to invest in a new project and finance part of the project by using common equity. Below is the information regarding cost of equity related to Sultana Berhad. So you have the cost of investment. This is a cost of project as well. Okay, 20 million. Portion of common stock financing requirement. So this is a common equity requirement, 65%. Retained earnings available for investment is 3 billion and the price per share is 16. Determine the number of common shares to be issued by Sultana upon utilizing retained earnings available. So that means you need to minus this retained earning before you calculate the number of units common stock. So first thing first, as usual, you need to find what is the common equity financing requirement. Okay, so this is the common equity financing requirement is 65% multiplied by the cost of project RM 20 million. Okay, that will give you RM 13 million. 13 million. So out of this 13 million, minus with the retained earnings available for reinvestment, retained earning for reinvestment, then the balance will be financed from the issue of new shares. So retained earnings available is 3 million. So RM 10 million, this will be financed using common or ordinary shares. Ordinary shares. Okay. So how many units that ordinary shares to be issued? So these RM 10 million. So the number of ordinary shares to be issued in terms of units. Okay, you need to divide this 10 million divide by the share price RM 16. Okay, so that is about 625,000 units. Okay, the answer is C. Okay, next question is 8. Recently, Post Prosperous, recently Prosperous Sdn Bhd has secured 2.5 million new project located at Sandiwara. At present, the optimal capital structure is as follows. So you are given here KD 9.15%, KP 12.6%, KE 20.5%, KNE, okay, 22.2%. Weight of financing is given as 60%. 60% common share. So this one is 0.6, and the balance of 40% equally portion bond and preference shares. So this is 0.2. This is 0.2. So this is the weight of financing. Okay, if the maximum capex of the firm is 3 million, suggest what is the firm's weighted average cost of capital. Okay, this one we can calculate WACC. 9.15 multiplied by 0.2. Okay, that give you here 1.83. And KP 0.2, 12.6 is 2.52. Okay, between this KE and KNE, you need to calculate what is the maximum capex first, which is 3 million. Okay, 3 million is given. So it's given already as 3 million. Then you need to compare the cost of project. Cost of project is the 2.5 million. 2.5 million cost of project. That means this is cost is lesser than maximum capex. That means the retained earnings is sufficient, is available to cover the cost of project. So we use the KE, which is the KE is 20.5%. 20.5%. So we'll take this 20.5%. Okay, 20.5% multiplied by 0.6. So that is 12.3. So 12.3. So you add to get the WACC, which is 16.65. So 16.65%. So the answer is A. Okay, question. The following question is on the project specific cost. 9, 10, and 11. Okay, refer to the Jom Transport Berhad is the transportation business industry. Composition capital structure 40% debt, equity 60%. Beta value of transportation is 1.34. In order to implement the firm strategic planning, board are considering venturing into construction business, which is totally different from the existing. Existing business is transportation. And the company has chosen Asam Bena as a proxy company. At present, Asam Bena has a debt to asset ratio of 0.2 to 1, beta value of 1.4. Jom Transport intends to maintain the existing capital structure and currently average return on stock market. So this is RM, 10%, RF, 4%. Corporate tax, okay. Corporate tax. So this is the RF. So this is the RM, okay. Corporate tax, pre-tax cost of debt 7.5. So this is KD before tax, because it's a pre-tax. So this is the TC tax rate. So calculate the asset beta, ungearing beta for the new venture. So this one is you want to calculate beta for proxy lah. Beta asset for proxy company, beta asset for proxy company. So proxy company is Asam Bena. Okay, Asam Bena Berhad. So you need to get what is the beta asset, not beta asset you want to find out. Beta value there is 1.4. So 1.4 multiplied by value of equity Asam Bena. So 0.2 to 1. Okay, debt to asset ratio, A or V. So E, so here 0.1, 0.2. So here is 1, so here is 0.8. Jadi 0.8 is the value of equity Asam Bena. Okay, then divide by value of equity Asam Bena plus value of debt Asam Bena 0.2. And don't forget 1 minus TC, tax rate is 24%. So 76. So you get the beta assets here is 1.176. So the answer is C. 1.176. Okay, then question 10, calculate using the same storyline. Calculate the new equity beta by regearing beta for the new capital structure, assuming ungeared assets beta for the new ventures is 1.471. 1.471. So you need to use this one lah, assets beta. BA dia kena guna 1.471. So you need to follow questions info. So 1.471. So here we need to calculate what is the beta equity Jom Transport. Jom Transport. So here beta equity is the beta assets. Okay, beta asset is given as 1.471 multiplied by the value of equity 0.6. So here debt equity 0.4, 0.6 for the Jom Transport. So 0.6 plus 0.4, 1 minus TC 76. Okay, then the whole thing here you divide by value of equity 0.6. Okay, so 0.76 multiplied by 0.4, okay, plus 0.6 multiplied by 1.471. We got 1.329, okay, 78 divided by 0.6. That gives you about 2.216. Okay, 2.216. So the answer is C. Okay, question 11. Determine the cost of equity using CAPM model. So this is the KE, assuming that the regeared equity beta is 1.772. Okay, I'm not sure why they are not using the figure that we compute. So we need to use based on the figure given in the questions. Okay, so here RM30 is the 10% and RF is 4%. So we calculate here RF4 plus beta given in the question as 1.772 multiplied by the differences of the return on market, 10 minus 4. 10 minus 4. Okay, so 10 minus 4 is 6. So 6 multiplied by 1.772. Okay, plus 4 is 14.632. 14.632. So the answer is A. So that's questions 11. Questions 11. Okay. So the last question is question 12. Question 12. Habibie Berhad, all equity finance company in education industry has a cost of capital 10%. Due to high potential market, board of directors thinking of expand into pharmaceutical. Additionally, an all equity listed company in the pharmaceutical has beta 1.1. Okay, expected return 12 and risk-free 2%. Determine the beta of education industry and identify which industry between education and pharmaceutical is less risk. Is less risk. So here, so you can identify what is the beta. So beta pharmaceutical is beta pharmaceutical pharmacy. Okay, is 1.1. So what is the beta education? So based on the CAPM, we can find out what is the beta education. Because you are given 10%, so this is the cost of equity equivalent to the risk-free 2 plus return on market, beta equity is we want to find out. Okay, expected return is 12 minus risk-free rate of return is 2, so it's 10. Then you subtract the formula. 10 BE, 10 minus 2 is 8. So 8, 10 minus 2 is 10 BE. Okay, so 8 BE is 8. BE is 8 divided by 10. Okay, so 8 divided by 10 is 0.8. 0.8, so that means beta education is less risky. Beta education is less risky, this one. Compared to the beta pharmacy. Okay, the rest of the question, start from questions 13, that is for next chapter, capital structure. So I think that's all for today. Our discussion on past semester questions and past tense. Past tests. With that, I think thank you very much for your attention. I hope that you get, you understand, okay, the knowledge and how to solve the questions, how to do questions past semester, ataupun how to do questions final exam and test for topic cost of capital. Okay, with that, thank you very much. Assalamualaikum.